Welcome to our deep dive on securing housing when income dries up. First, we will frame the core problem. With high housing costs and limited future Social Security growth, every extra dollar needs to work for housing security. Next, we will explain the liquidity mandate, why high-yield savings accounts become your anchor, and how to structure deposits. Then, we'll discuss insurance pitfalls that can drain your cash flow. Finally, we'll cover long-term care and Medicaid planning so you can protect essentials and qualify for help if needed. Here's the roadmap. First, we cover what liquidity means and why it is your top priority. Next, we show you how to quickly build a strong cash buffer. Then, we highlight common insurance pitfalls that can erode savings. After that, we discuss long-term care and Medicaid planning. Finally, we wrap up with a clear action plan and resources. Before we begin, please note this content is educational only. It is not financial, legal, tax, or insurance advice. Rules for Medicaid, insurance, and banking change by state and over time. Always consult a qualified elder law attorney, a fiduciary financial planner, and a licensed insurance professional before acting. With that said, let's proceed carefully and methodically. Liquidity is your first line of defense when your timeline is uncertain, often 5 to 10 years, and funds are needed for essential housing costs. Principal safety and easy access matter more than chasing returns. Therefore, the anchor of your plan should be a high-yield savings account because it preserves capital while keeping it immediately available. Meanwhile, avoiding high-risk or illiquid options helps ensure that money earmarked for rent or mortgage remains intact. Now that we understand the why, we will shift to the how. Start by choosing a high-yield savings account that is FDIC or NCUA insured, without monthly fees, and with a competitive variable APY. Next, automate $2,000 per month into this account on the same day income arrives, which removes decision fatigue. Then, segment your cash into separate labeled buckets: essentials for housing, emergency for unexpected costs, and future care for potential health-related expenses. Maintain between 6 and 24 months of housing payments in the essentials bucket, and top it up monthly, quarterly. Review the APY and fees, and be willing to move if the situation deteriorates. Importantly, do not invest these funds in risk assets, because capital preservation is the primary objective. Now let's visualize the decision path. This flowchart shows the monthly routing of income. First, determine if the dollars are for essentials. If yes, they go straight to the essentials bucket in your HYSA. If not, check whether your emergency cash is fully funded. If it is not, prioritize building the emergency bucket. If it is, assess whether you have high-interest debt to pay down. If that is also addressed, consider your investing horizon. If your horizon is longer than 10 years, and funds are not for essentials, then a diversified low-cost portfolio may be considered. If not, keep funds in HYSA or short-term CDs. Throughout, automate transfers and review quarterly as your housing costs change. This illustrative table shows how consistent deposits accelerate your buffer. We assumed a 4% annual percentage yield with monthly compounding for a simple estimate. Each month, interest accrues on the existing balance. Then you add $2,000. Over 12 months, the balance exceeds $24,000. Providing multiple months of housing coverage. Next, we will test your understanding with a quick quiz. Quiz time. If your funds may be needed in the next 5 to 10 years for housing payments, where should they primarily be kept? Option A is a high-yield savings account. Option B is penny stocks. Option C is a whole life insurance policy. Option D is a sector-specific mutual fund. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is A, a high-yield savings account. When survival expenses are at stake and the timeline is uncertain, capital preservation and immediate access outrank return chasings. Now, let's turn to insurance pitfalls that can reduce your savings power. Insurance can be useful, but certain late-life policies can be traps. In particular, watch for excessive premiums or clauses that convert to less valuable term coverage at advanced ages. These features can quietly drain cash flow needed for housing. With that context, we will unpack specific red flags. Key red flags include premium drag, where a $455 monthly premium reduces your cash buffer by more than $5,000 per year. Watch for conversion clauses that automatically shift coverage to term around age 80, often reducing value. Be careful with complex riders that have unclear benefits and high internal costs. Check surrender fee schedules before canceling or making changes. Finally, apply the liquidity test. If you cannot readily access value to cover housing, the policy may not serve your immediate needs. Next, we will compare cash-first versus premium-heavy approaches. On the left, the cash-first plan maximizes HYSA deposits, provides immediate access for essential housing expenses, carries low risk, and offers flexibility as needs change. On the right, a premium-heavy plan diverts significant funds to an insurance policy, reducing liquidity and increasing complexity. If the policy converts to term at an advanced age, value may drop materially. This comparison underscores why cash should generally come first for housing security. Now, let's check comprehension with a quick quiz. Second quiz. If a late life policy costs $455 per month and may convert to term at age 80, what is the prudent first move? Option A is to keep paying because it is insurance. Option B is to redirect premiums to savings without any review. Option C is to obtain an in-force illustration, review conversion terms and fees, and likely prioritize building liquid cash first. Option D is to cancel the policy immediately over the phone. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C. You should request an in-force illustration and analyze conversion terms and surrender fees before making changes. Once you understand the details, the likely priority is to build liquid cash reserves first to secure housing. Now, let's move into long-term care planning and Medicaid eligibility strategy. This pie chart illustrates a sample budget prioritizing housing, medical needs, and a dedicated savings slice for your HYSA buffer. The discretionary category is intentionally tight until the buffer reaches at least 6 months of housing costs, preferably more. Review and rebalance your percentages quarterly as prices and needs shift. Next, we will visualize Medicaid timing considerations. This timeline highlights the typical 5-year look-back period for Medicaid eligibility. From today forward, document every transfer and expense meticulously. Use allowed spend-down methods under your state's rules and avoid disqualifying transfers during the window. The goal is to protect essentials, maintain your housing buffer, and align with eligibility requirements. Now let's translate this into a concrete strategy checklist. Strategic asset positioning starts with robust documentation. Maintain records of bank statements, transfers, and medical expenses. Where permitted by state law, prioritize exempt assets, and use allowed spend-down methods on necessary expenses, debt, medical costs, and home safety improvements. Avoid gifts during the look-back period because penalties can postpone eligibility. Integrate your housing buffer with care planning so that you do not deplete the essentials bucket. Finally, engage an elder law attorney to craft a plan consistent with your state's specific rules. Next, we'll consolidate the key points. Here are the key takeaways. Liquidity comes first when housing security is at stake. Automate $2,000 per month into a high-yield savings account and aim for 6 to 24 months of housing costs. Be cautious with late life insurance policies, especially those with high premiums or conversion clauses. Plan early for long-term care and understand the 5-year look-back. Finally, document everything and consult qualified professionals to align your plan with state rules. To wrap up, open and fund your high-yield savings account immediately and automate deposits. After obtaining policy details, consider reallocating from questionable premiums to liquidity. Track every transfer and expense with the intent to preserve eligibility for assistance programs. Reassess your plan quarterly and adapt to changing costs and rules. Finally, let's close with a quick thank you and a call to action. Thank you for watching. If this was helpful, please like the video, share it with someone who needs it, and subscribe for more practical retirement strategies. In the comments, tell us your next move toward building a housing buffer and planning for care. We look forward to hearing your thoughts and questions.